Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out what's really going on inside big companies, even when they use fancy words to hide it. Today, we're diving into Target's latest annual report. Usually these reports have at least a few surprises in store, and let me tell you, this report is no exception. Seems like Target is focusing on looking trendy, but are they actually making money? We'll see if their financials match their fashionable image. Key topics today: a slight dip in sales, a close look at what people are buying, and a few potential storm clouds on the horizon. Let's decode. This report covers Target's performance for the year ending in early 2025. It's basically a yearly checkup, giving investors and us a detailed view of how the company is doing financially, what risks they see, and what their plans are for the future. Think of it like Target's report card. First, a few basics. The report confirms this is Target Corporation, trading under the ticker symbol TGT. Their main office is in Minneapolis, Minnesota. Nothing too shocking here, but it's always good to confirm we're looking at the right company. Target is indeed a large accelerated filer. This means they're a big company and they have to get their financial information out there faster than smaller companies. This number tells you how much the company is worth on the stock market. As of last August, Target stock held by non-affiliates was worth about $64 to $1 billion. That gives us a rough idea of the scale we're dealing with. Target incorporates parts of their upcoming proxy statement. This is common as it avoids repeating information that will be shared with shareholders soon anyway. Now let's get to the heart of what Target does. Their core business is selling merchandise to customers, both in stores and online. They're trying to make shopping easy and convenient, which is why stores handle most of the online order fulfillment. Here's where we start to see the real story. Tent net sales are down slightly from $109 billion to $106.6 billion. The extra week in 2023 did give them a $1.7 billion boost. The takeaway sales are a bit soft. It shows over 96% of their sales are fulfilled by stores. Their website and app account for less than 4% of their total sales. Target's strategy continues to leverage stores as fulfillment hubs. This shows where Target is making its money. The biggest categories are food and beverage and household essentials. Those two categories alone make up close to 40% of all sales. Style and home decor are also important. Target is heavily invested in its own brands. They list a ton of them here. They are focusing on exclusive brands that you can't find anywhere else, and many of these brands generate over $1 billion in sales each year. Target emphasizes human capital management quite a bit. It is clear they're trying to be an employer of choice, offering benefits like tuition reimbursement and mental health services. Their workforce totals about 440,000, but they do rely on seasonal workers. The most important thing, workplace safety is a priority. Target faces a lot of competition. They list pretty much everyone: department stores, online retailers, discount chains, supermarkets, the works. Their success hinges on convincing people that Target offers something different and better, not just the lowest price. Time to brace ourselves. Every company has risks and they have to tell investors what they are. Let's see what Target is worried about. First up, competitive pressure. Target knows they need to stand out. If they can't, their performance could suffer. Online shopping is making it harder to differentiate based on price, so they have to compete on experience, convenience, and unique products. Reputation is crucial. Bad press, whether accurate or not, can hurt Target. They mentioned that they've already faced negative perceptions in the past. Their customer base is diverse, and some positions can alienate portions of their customers and may cause consumer boycotts. Owned brands are a big deal, but they also carry risk. If Target can't keep coming up with appealing products, or if quality suffers, their profits will take a hit. Here's a big one. Inventory shrinkage. That's a fancy term for loss due to theft, damage, etc. Target admits they've been experiencing higher than usual losses lately. This is a major problem for retailers because high inventory shrink at certain stores contributed to store closures. Cybersecurity is always a worry. If their systems go down, they can't process transactions or manage inventory, which could damage their reputation and bottom line. They have experienced disruptions in their point of sale system in the past. Target relies heavily on its relationships with vendors. Trade disputes, tariffs, or problems with suppliers could disrupt their supply chain and raise costs. We saw how bad these effects can be in real time the past few years. The impacts of a changing climate present a variety of risks in the short term and long term. For example, natural disasters and extreme weather conditions could be widespread and damage their business by increasing their costs, disrupting their supply chain, negatively impacting their workforce, and even threaten habitability of locations. Now, Target gets into some details about how they manage cybersecurity. The board of directors and its committees oversee information security. They are responsible for identifying, assessing, and managing risks related to these topics, and reporting to the Audit and Risk Committee and/or the full board of directors. They use a combination of tools and threat intelligence to find and deal with risks. They also test their systems and have an incident response plan. They are trying to work with other companies to get smarter about security and use leading vendors in the technology space. All this emphasis on cybersecurity and use leading vendors in the technology space. All this emphasis on cybersecurity makes sense, given the data breach they experienced in the past and its negative consequences. Let's move on to the numbers. This section is management's explanation of their performance. The highlights: earnings per share were $8.86. Net sales are slightly down, but comparable sales increased a tiny bit. Operating income is also down slightly. This table compares earnings per share for the past 3 years. It shows that earnings are down slightly compared to last year. The gross margin rate, which is basically profit margin, increased a bit from 27.5% to 28.2%. This means they're making a little more money on each sale. One of the key components is that merchandising costs are down but are offset by higher promotional and clearance markdown rates, plus higher advertising and marketplace revenue. Lower book to physical inventory adjustments helped improve margins in 2024. With over 400,000 team members, workforce costs represent their largest operating expense, meaning Target needs to find, hire, and keep employees. There have been and may continue to be changes in the legal or regulatory environment affecting many areas related to their business, including worker availability. Here, Target tries to give a clearer picture of earnings by adjusting for some unusual items. In the end, the adjusted earnings per share are essentially the same as the regular earnings per share, so there weren't any hidden surprises. After-tax return on invested capital, or ROIC, is the amount of money Target earns with the capital that was invested, and the higher the better. Here it went from 16.1% to 15.4% to 15.4%. This is a slight decrease, but in general is still looking healthy. Year-end inventory was $12.7 billion compared with $11.9 billion in 2023. This seems like a red flag showing inventory is outpacing sale rates. Capital expenditures are investments in things like new stores, remodels, and supply chain improvements. The other plan is to invest less than the previous year due to a slowdown in store remodeling and facility improvements. Target depends on access to financial markets. If their credit rating gets downgraded, it could make borrowing money more expensive. They have also derivative products to manage our exposure to market risk, principally interest rate fluctuations. Finally, we arrive at the formal financial statements. These are the official numbers audited by Ernst & Young. Take a look at the numbers. In the 2024 year period, we saw $106,566 revenue, $76,502 in cost of sales. So at the end, there was $4,091 net earnings for Target. Looking at the balance sheet, total assets at the end of 2024 are $57,769 million. Total liabilities are $22,340.27 or $43,140 million. So total equity is around $14.7 billion. This confirms that Ernst & Young has audited the numbers and gives them a thumbs up. Ernst & Young believes the numbers are accurate. List of exhibits. These are the contracts and legal documents that underpin the report. For example, there's the aircraft timesharing agreement, a reminder that top executives often get perks like private jet use. So what's the overall picture here? Target is a massive retailer facing increasing pressure to stay relevant. Sales are down a bit, and while profits are holding up, they're facing rising costs and increased competition. They are walking a very fine line of trying to please every one of their customers with varying opinions while trying to innovate to the future. The inventory and labor risks are definitely something to watch. They need to manage inventory effectively to avoid losses and stay competitive, while workplace safety is also a concern. It's going to be a tricky balancing act, but they have a good foundation with some valuable, unique brands. In conclusion, Target is a major player, but the retail landscape is shifting. They need to execute their strategy flawlessly to maintain their position and make sure these risks don't become major problems. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, give us a like, drop a comment, and subscribe for more deep dives into the world of corporate filings.